Welcome to the Deep Dive. Today, you're joining us as we take a close look, a really close look at the first quarter results for fiscal year 2026 from TJX Companies.
Right. The folks behind TJ Maxx, Marshalls, HomeGoods, those stores, lots of us know.
Exactly. And we've got their official earnings release,
Yeah.
notes from their conference call, plus some, analysis from Zacks.com and the Motley Fool,
Yeah.
all dated May 21st, 2025.
And our mission here really is to cut through all the financial jargon. We want to figure out what these numbers actually mean for TJX.
Yeah, how are they performing? What's the outlook? And what does it maybe tell us about retail overall?
Think of it as a shortcut, helping you get informed on what's really going on with them.
Okay, and to get you thinking right away, here's something that really jumped out at me. TJX actually beat expectations.
Mm-hmm. On earnings and revenue for Q1.
Sounds great, right? But on the day they announced this, their stock price went down.
Yeah, kind of weird.
So that's the big question we want to unpack today. Why the disconnect? What's behind that?
Okay, let's dive right into those headline numbers. This is for Q1 fiscal 26, which ended May 3rd, 2025. Net sales, $13.1 billion.
That's a solid jump, right? Up 5% compared to the same time last year?
Definitely a solid increase. And importantly, their consolidated comparable store sales were up too, by 3%.
Okay. And comparable store sales, that's looking at stores open at least a year. Yeah, it's a key metric.
Exactly. It shows underlying health. And that 3% was actually at the high end of what they planned for.
And driven by more foot traffic.
Yeah, more customer transactions. And that was across all their divisions. Marmaxx, HomeGoods, Canada International, people were coming in.
But what about profitability? Sales are one thing, profit margins are another.
Right. So their pre-tax profit margin was 10.3%. Now, that did beat their own plan.
Okay.
But it's actually down a bit from last year. Same quarter last year was 11.1%.
Ah, okay. So selling more, but that profit slice is a little thinner this time around. What about earnings per share, the EPS number investors watch so closely?
Diluted EPS came in at $0.92. Again, like the profit margin, better than they expected,
Yeah.
but just a tiny bit lower than the $1.30 things they reported in Q1 last year. So it's a mixed picture there.
More people buying things, definitely positive. But overall, profitability not quite keeping pace. Now, Zacks.com had some analysis on this too.
They did. They pointed out that the total revenue, $13.11 billion, actually edged out the Wall Street consensus, the Zacks estimate, by about 0.67%.
Okay, so it's slight beat on revenue estimates.
And the EPS, that now 92 cents, also beat the analyst consensus, which was ZAST 90 cents.
So they beat on both the top and bottom lines compared to expectations.
Yes. And what Zacks found interesting and kind of underlines TJX's performance is this pattern. They've beaten the EPS estimates for the last 4 quarters straight.
4 quarters.
And beaten revenue estimates for the last 4 quarters, too. So there's a history here of, exceeding expectations.
Okay, that consistency is definitely noteworthy. Let's break down the performance by their different store groups then. What were the highlights?
Right. So Marmaxx first. That's TJ Maxx, Marshalls, Sierra in the U.S. Their comparable sales were up 2%.
Okay, 2% for Marmaxx. Profit margin.
That was actually down slightly for the segment. They did say sales picked up momentum in March and April, maybe helped by better weather,
Makes sense. Spring shopping.
Yeah, and they saw good growth online and specifically in their Sierra stores, too.
Okay. What about HomeGoods? That division's been getting a lot of focus.
HomeGoods had a stronger quarter, actually. Comp sales up 4%.
Oh, nice jump there.
And their segment profit margin actually increased. They talked about strong performance in both HomeGoods and HomeSense banners here in the U.S. They feel they have a really differentiated mix of home fashions.
Right. The unique selection seems key for them there. Okay, let's hop over to Canada. TJX Canada.
Canada also saw strong sales. Comp sales up 5%.
Another good number.
But their segment profit margin was down. TJX chalked that up mainly to unfavorable foreign exchange.
Ah, the currency headwinds.
Yeah.
So sales were good in Canadian dollars, but worth less when converted back to U.S. dollars.
Pretty much, yeah. It impacts the reported profit margin. But they did stress they're still the leading off-price player up there in Canada.
Got it. And the last piece, TJX International,
Yeah.
Europe and Australia.
Also a 5% comp sales increase, TK Maxx and HomeSense. And interestingly, their segment profit margin actually went up if you adjust for currency effects.
Oh, okay. So strong performance there.
Yeah, they mentioned continued strength in Europe and called out Australia as having outstanding sales. And they're planning to bring TK Maxx to Spain next year.
Interesting expansion. So looking across the board, sales are generally trending positive. But that overall profitability,
Mm.
it seems a bit squeezed. What are the main culprits there?
Well, there are a few things going on. First, the gross profit margin, basically sales minus the cost of the goods they sold that decreased.
Okay. Why?
TJX said it was mostly due to unfavorable mark-to-market adjustments on inventory hedges. It's a bit technical,
Yeah.
but it's basically accounting adjustments related to the value of contracts they use to manage currency risk. Those adjustments went against them this quarter.
Okay, so some financial mechanics impacting the gross margin. What else?
Second, their operating costs, SG&A, selling, general, and administrative expenses, went up slightly as a percentage of sales.
Right.
Two main reasons there. One, they were comparing against a quarter last year where they had a one-time benefit from releasing some reserves. That made this year look worse by comparison.
Okay, that's the lapping effect.
Exactly. And two, they had some higher costs for store wages and payroll this year.
All right, understandable pressures. And you mentioned interest income earlier.
Yeah, a smaller factor, but net interest income was lower too. It dragged down the pre-tax profit margin a bit compared to last year just because they had less cash sitting around on average, and interest rates were a bit lower.
Got it. Okay, let's shift from the financials to the actual stuff, the merchandise. What's happening with inventory?
Inventory levels are up, noticeably. Total inventory is up 15% year over year.
15%. Wow.
And per store, it's up 7%. But interestingly, TJX management seems quite positive about this.
Really? Usually big inventory jumps can be a worry.
Right, but they framed it as having access to excellent deals in the marketplace. They see outstanding merchandise availability and feel this position gives them flexibility.
So they're buying opportunistically because the deals are good. How do they manage sourcing all that stuff globally?
It's a massive operation. They've got over 1,300 buyers,
Right.
and they source from over 21,000 vendors.
21,000.
Yeah, across more than 100 countries. It's huge. Though they did mention that directly sourced products, things they have made specifically for them, are actually less than 10% of the business.
Oh, interesting. So mostly buying existing brand name overstock or closeouts.
Seems that way. And they don't plan to change that balance much. They also talked about buying strategically closer to need, hand-to-mouth buying, they called it.
Wow.
Lets them jump on deals quickly.
Okay, with all that global sourcing, the inevitable question, tariffs.
Yeah.
How are they impacting TJX?
Management acknowledged the pressure, yeah. They said tariffs are definitely a factor, but they feel they can navigate it. Well, they did warn that Q2, the current quarter, will likely see the biggest hit to gross margin from tariffs. That's on stuff they'd already committed to buying before recent changes, perhaps.
Okay, so a short-term bump coming.
Seems like it. But their forecast for the whole year assumes tariffs stay where they are right now.
And what are they doing to, lessen the blow from tariffs?
They have a few strategies. Leveraging their buying process to find value, adjusting ticket prices carefully while still maintaining that big discount versus department stores,
Right, protecting the value gap.
Exactly. Also diversifying where they source products from and just generally trying to be more cost efficient across the board.
And Zacks.com thought the details on this were pretty important.
Yeah, Zacks noted that what management said on the earnings call about handling tariffs would be key for investors trying to gauge if the stock price can hold up given these pressures.
Makes sense. Okay, looking forward then. What's the official guidance from TJX for the rest of the year?
For the full fiscal year 2026, they're sticking with their previous forecast for comparable store sales growth, 2% to 3%.
Okay, consistent on sales growth.
But they now expect the full year pre-tax profit margin to be slightly down compared to last year.
Ah, okay, so acknowledging some pressure there.
Right. And the full year diluted EPS forecast is for an increase of 2% to 4%. That puts the range at $4.34 to $4.43 per share.
All right. And for Q2 specifically, the quarter we're in now.
Second quarter comp sales growth is expected to be similar to the full year, 2% to 3%.
Okay.
But again, they expect the Q2 pre-tax profit margin to be down compared to last year, and the Q2 EPS guidance is $0.97 to $1 per share.
Okay. Now, this seems to bring us right back to that puzzle. Why the stock drop? The Motley Fool article tackled this directly, right?
It did. The Fool suggests that even with the Q1 beats on sales and earnings, the stock dip was likely a reaction to that forward-looking guidance.
Specifically the earnings part.
Yeah, particularly the full-year EPS target. That range of $4.34 to $4.43, well, it fell short of what the average Wall Street analyst was predicting.
Okay. So analysts had penciled in something higher, perhaps based on the Q1 strength, and didn't fully bake in those margin pressures TJX is now forecasting.
That seems very likely. The market is always looking ahead, and that guidance just wasn't quite as optimistic as analysts or perhaps investors were hoping for.
So good recent performance wasn't enough to outweigh a slightly less rosy future outlook.
Seems that way. The Motley Fool also mentioned that maybe some broader concerns about the economy, potential headwinds for sales and margins down the road could be contributing too.
Right. General macroeconomic worries layering on top of the specific guidance. Investors might be thinking, okay, Q1 was good, but can they keep it up if tariffs bite harder or consumer spending slows?
Exactly. It highlights that focus on future profitability, especially when there's uncertainty around.
It's definitely a reminder that markets price in expectations, not just past results. Now, TJX is also active in returning cash to shareholders.
Oh, definitely. In Q1 alone, they returned $1.0 billion. That was through share buybacks and dividends.
$1 billion in one quarter.
Yeah. And they plan to repurchase another $2.0 to $2.5 billion worth of their stock over the whole fiscal year. Plus, they ended the quarter with a healthy $4.3 billion in cash on hand.
So financially, they seem quite solid and committed to shareholder returns, despite the market's reaction to guidance. What are the core strengths TJX themselves are highlighting right now?
They're really leaning into their core value proposition. Brands, fashion, quality, price, that combination they offer.
The off-price model.
Precisely. They also emphasize their huge, experienced global buying team and those deep vendor relationships. Remember, 21,000 vendors.
Hard to replicate that scale.
For sure. They also point to their broad customer appeal, attracting shoppers across different income levels and age groups, and the flexibility of their business model.
How so?
In buying, in-store operations, supply chain.
Yeah.
It all enables that treasure hunt shopping experience people seem to love, finding unexpected deals. And finally, they just underscore their deep off-price expertise and their experienced leadership teams.
Okay, so let's try and wrap this up. What are the key takeaways from this deep dive into TJX's Q1?
Well, in a nutshell, TJX had a strong start to the year. Sales beat expectations, earnings beat expectations, driven by more customers coming through the doors. That's the good news. But the stock market reacted negatively, and the main reason seems to be their forecast for the full year, especially earnings per share, which didn't meet analyst expectations.
Likely reflecting those worries about future headwinds, like tariffs impacting margins, particularly in Q2.
Exactly. It really highlights that disconnect that can happen.
Yeah, it's really interesting, isn't it, how a company can report positive results for the recent past, but still get a somewhat skeptical reaction from investors looking ahead.
It absolutely is. That contrast between the backward-looking report and the forward-looking stock price reaction tells you a lot about market dynamics.
So here's something for you, the listener, to mull over. How does a company navigate that? Performing well now, but facing investor doubt about the future, especially with things like tariffs and economic shifts in the mix.
Yeah, what does that tell you about how you might balance current performance versus future projections when you're looking at a company? It's a key question.
Definitely food for thought. We'd encourage you to maybe look deeper into what drives retail stocks, how global trade really affects the stuff we buy, and the specific ways TJX plans to keep delivering that value promise going forward.